Everybody, good evening. Welcome to the Thursday Financial Thing live stream. Thank you for tuning in, whether you are listening live or in the future. We have a great Q&A session this evening with CEO of the money platform, George Huntley, who was here almost a little bit more than a year ago. So George reached out and asked me to if we could have another chat, and so we could learn more about the money platform and what they're doing. So I'm going to have that for you. Don't forget, in 2 weeks' time, on the 30th of November, we're going to have Cufflink CEO Narinder Kaur here live also for another Q&A session. And also, don't forget, this is sponsored by Cufflink, as is the YouTube channel every week. Their generosity in supporting the channel. If you can go ahead and return the favor and support them, that helps Financial Thing out a ton. So you can earn up to 9.83% interest gross per annum. Just a little bit shy of £300 million of property-backed UK investments now made since 2016. Zero investor losses to date. Your capital is at risk. Please don't invest more than you're prepared to lose, money-wise, and the interest rate can change as interest rates are do change now and again. You can sign up at join.cufflink.com/financial-thing. I know many of you already have Cufflink accounts, but if you don't, please check it out. Yes, Harley is definitely being watched. She says hello. So we're going to jump right into it and get George on the line and have a chat with him. If you have questions for him, just put them in the chat, and we'll get to them at the end, as we always do. Let me see. Let me pull up George here. 1 second. Pray to the technology gods that everything works. Okay, there we go. There he is, Mr. George Huntley himself, the money platform. Welcome, George. Thank you for being here again, your second time. How are you doing? Yeah, how are you? Well, no, yeah, you're absolutely totally fine. Let me just make sure everything is coming through okay. Say hi real quick. 1 second. Let's see. Hang on. Let me know in the chat if you can hear George. Hopefully you can. I'm not 100% sure it's coming. I can absolutely hear you. Totally fine. I just want to make sure everybody out there can. So just let me know in the chat if George is coming through loud and clear. Hang on. There's always something to do with technical issues in life, isn't there, George? You know, it's just it's just the way it goes. I'm sure everybody will let me know if nothing is coming through. I think it's okay, but let me just double check. 1 second. Yeah, they're saying we can't hear George. 1 second. It's not you. It's definitely my end. Just 1 sec. I think I know how to fix it. Let's try this. Okay, try speaking again.
Can you hear me now?
I can hear you. Let me just.
You can hear me, but
yeah.
The others can't. Yeah.
Let me just verify that. Hopefully, let me know now. I think I might have fixed it, but let me know if you can hear George okay now. Just somebody out there. 1 second. User cancellation. I don't know what it is with Skype. It's just it's supposed to work in. Hang on. Just be patient, everybody. I know we'll get there. We'll have George. I'll call him back in a second if it doesn't work. But all good now. Okay, we're good.
All good. Hooray.
That makes me happy. I get very nervous about this technical stuff. All right, so George, yes, again, thank you for being here. Of course, you were here, I think it was September, I want to say, of 2021, because I did look back at the archives, and we had kind of reached out to each other for having a little bit of a catch up. I'm always
Yeah.
like to kind of check in after a year and see, how things are going. Obviously, the landscape in peer-to-peer is forever changing. Some people say it feels like it's contracting. Well, I personally look at it where the companies that are still here now are the ones that are sort of the backbone of the industry now, where you may not have a ton of other new entrants into the market. So let's talk about how has the money platform really changed since September of 2021 in the way that you
Yeah, I
guys
think it
are
was
doing business?
2022. I think it was last
You're
year,
right.
not 2021.
You're right. 2022.
Yeah, the
Yep.
years fly by.
Lord.
Yeah, so I mean, we've grown, which is really good. Which I think a lot of peer-to-peer platforms have struggled on that front. So last month we did 1.2, just shy of 1.2 million of loans funds going out the door, which was great, and that's up from 800,000 last October, so October 2022. So I think just after we last spoke. So that was really good. We've launched a new product, which I think I probably talked about this time last year. So that's a longer, larger 12-month loan product at a lower APR. We've kind of been testing that throughout the course of this year. It went live last December, and we've been kind of tweaking our scoring for that, hoping to launch that more widely early next year. We've rebuilt our credit decision engine. So as some of your listeners who have lent on our platform will know, we've built our own credit decision engine, and we've actually completely rebuilt that from scratch over the last 12 months. We've incorporated some different bits of data. It's much more flexible now. It's much easier to see where, pinpointing where we can make changes. So that's really exciting.
Can you talk a little bit more about that, about this? So what versus, say, a year ago were you doing differently? Because the credit decision is quite an important one, isn't it? You're trying to kind of figure out who's going to pay and who's going to not pay. So what kind of things did you change to make it more usable?
Yeah. So it's kind of it's vital. It's at the absolute heart of what we do. So what we did is we previously all the rules were bolted onto each other, and there wasn't I guess a huge amount of logic to how the rules have been laid out. So we just moved them into an entirely new system, and that has made us able to drill down into what rules are working best and what rules aren't working best, what's blocking customers coming through, and what scores work best for us, I think, as well. And we're only just starting to see the fruits of that now, being able to look at the data in more detail and see what tweaks we can make to firstly, I guess, allow the default rate to drop or become more predictable, and secondly, to allow good customers to get through and not be rejected. So we built it in a new system called ADP, and that is also it's a codeless system, so it means that we're much more agile in terms of making changes to it. It's much quicker to ship out new updates to our credit decisioning, and so that means we have a meeting and we discuss rates of payment and different bits to do with credit decisioning every week, and it means we can get the changes out same day, whereas previously it might take a week or maybe a month or maybe longer for some of the less important changes. So it means that we're just much more on the ball, and you compare that to big banks or even to other digital lenders, and it just takes a long time for people to make changes to their core decision platform. It's so great for us that we can make changes immediately. But another thing that's changed, is obviously interest rates. I don't want to shy away from the fact that peer-to-peer lending, it's gone through a tough time over the last year. And, we've seen lenders withdraw money, but returns have stayed strong. So we've seen some new lenders deposit. And I was looking actually just before the call, we've had, I think, £3.8 million of deposits since inception, so over many years, and we've had 3.4 million of withdrawals. So we've only got a net £400,000 on the platform, but we're still lending 1.2 million a month. So that just shows, like, returns are really good, but lenders for some reason are still withdrawing money, and that doesn't make a huge amount of sense to me.
No, and I probably jumped ahead a little bit forward than I should have done, but I was going to ask you, for anybody that is unfamiliar, obviously, with the money platform, we didn't really explain what it is that you do in a very brief 60-second pitch to anybody out there that's wondering, what does this guy do and what does the company do? Maybe you could just tell everybody.
Yeah, sure. So the money platform, it's a peer-to-peer lending platform focused, or at least originally focused on innovating and disrupting the high cost lending space, so short-term loans, and trying to add some much needed competition into that space. We typically do a £500 loan for 3 months, and we try and kind of compete with other providers in that space by being better for the borrower, and possibly delivering a slightly better interest rate for the borrower where we can. And obviously we're able to do that because we've got a great group of lenders who many have been with us for 6 or 7 years now, and have been lending on our platform. Now we're slightly shifting, truth be told, towards the kind of near prime, mid prime space. So we've got this 12-month product that I talked about earlier, which was launched last December, and we're hoping that will be a big growth engine for us. So that's a lower APR product, and it's focused, I guess, on people wanting to consolidate their debt. So the money platform, peer-to-peer lending, short-term lending, typically at the higher risk subprime end of the spectrum, and so for many people who have ever borrowed in that space, they'll know that it's been historically kind of dominated by a few kind of slightly dodgy companies, and we like to think of ourselves as kind of I guess more ethical, lending to people with the intent of helping them rather than with the intent of trying to screw them over. And how do we do that? Well, we provide some tools by which they can improve with their money management. And actually all of these things have come together to deliver us really, really high levels of customer satisfaction. So if you go onto our Trustpilot, for example, we're at 4.8, which is, I think, like by far and away one of the highest rankings for any lending business, full stop, let alone any lending business operating in the subprime lending space. So, this is an area of the market, Lawrence, which you probably know about, but it's an area of the market that a lot of people just don't have access to credit, full stop. And we think it's really important that there are platforms like ours who are trying to lend into that space and do a good job for lenders and for borrowers in that space.
So if somebody comes to you and wants to use their money to lend out on the peer-to-peer investment side, what kind of rates can they expect to achieve right now in the current environment?
Yeah. So we forecast, so for the coming year, we're forecasting a 15.4% IRR. So that's like an internal rate of return. It's kind of what you should expect to get at the end of the year if you lend for that full year. Mm-hmm. Last year, I think we forecast, I've got it here somewhere, we forecast 13.4%. It actually came in above that, so it's come in currently at 26.0%. So really, really good returns last year. Obviously, we forecast 15.4% this year, so we're not necessarily expecting to get up to the 26% again. But that's the kind of area of the returns that we're looking at. So it's kind of double-digit returns. I think like decent level of risk. Obviously, high risk area of the market, but decent returns to compensate lenders for that. And we've got a track record of delivering returns now for several years. I think we did our first loan in October 2016. So this must be, we're about 7 years in now. So been around the block for a long time.
George, how old were you 7 years ago? Everybody always asks me that about you because they say, George.
I was 24, so I was young.
You got a face that never ages. You're very lucky. So tell me, since we spoke, a year ago, what would you say one thing that you've learned that has changed between a year ago and now about the way the business operates, and maybe something you look back and go, I wish we'd done that differently that you know now?
Yeah, good question. I think, so I mentioned some of the tech projects that we've done, moving our credit decision engine over, launching a new product. Another one was that we completely rebuilt the borrower journey, which I haven't mentioned, but we've done that. I think I continuously underestimated how much work that would be and how much time it would take to get those projects across the line. So it's not necessarily relevant to your audience, Lawrence, but big tech projects are really hard. They're complicated, and they take a lot of time. That's one lesson. I think on the lending side, one lesson is that the macroeconomy is pretty irrelevant for our segment of the market. I should just caveat everything I say, by the way, that this is not financial advice, and you should speak to a financial advisor before lending on our platform. But our segment of the market doesn't seem that impacted by big macroeconomic shifts that you might read about on the news. And I think that's because we benefit from, in the cost of living crisis, we probably had a better quality of applicant coming in. And then in good times, people are maybe more able to repay credit. So there's a kind of a balancing act there. But we haven't seen a lot of lenders, 12 months ago, very concerned, interest rates going up, cost of living crisis, energy prices. They were concerned that was going to dent returns, and we didn't see that. We saw returns being higher than forecast. So that's another lesson that I think I've learned. I think I've also learned, Lawrence, probably that when you do things that help our borrower customers and make life easier for them, it makes life a lot easier for the business and for lenders. So one of the things we did was rebuild the customer journey for borrowers. They now select their payment date, whereas previously we just allocated them a payment date. So if they had a 3-month product, they'd have three payment dates, kind of each a month away from when they started the loan. And we've now given them the choice to select their payment date and to select which day they actually get money into their bank account. And that's seen customers, just the number of payments going through on the first attempt has just gone through the roof. I think it was maybe more like 50%, which meant that the operations team were having to contact a lot of people. I just looked just before I joined this school, and I think out of maybe a couple of hundred payments that were due today, there was maybe a handful, maybe 3 or 4 that didn't go through. So it's making our life a huge amount easier. I hope it's gonna. We've only just gone live with that relatively recently, but I hope and I expect that it will lead to better lender returns, or at least less volatility in lender returns. So that's something else that
that's a big small change too, right? To think about, well, let us let the people pick when they want the payment date to come out. Something that you don't necessarily probably think about as being a big deal, but for maybe people that are living a little bit lean, it's important for them to get that option.
Yeah, 100%. Yeah, definitely.
I wanted to ask you. So you had mentioned about lender withdrawing money from the platform. That must be a little bit kind of frightening as a peer-to-peer lending company that relies on retail money to make the business move. Have you contacted any of those lenders to ask, what is it that's making you want to pull money back from the platform? Because I'm sure too you get people that put it in and take it out when they need it. But what's the consensus been about the withdrawing side and the lenders?
So I think like historically peer-to-peer lending has probably been used by people who want a proxy for a bank account. Now our area of the market's never been a proxy for a bank account. This is very much an investment, and it's a risky investment. It's not like putting your money in a safe bank, or putting in a bank full stop. So it's not a safe investment. So I think some people probably were just moving their money from peer-to-peer lending into secure banks. I think that's part of it. I think another part of it is people just having life events. Maybe they decided to move house and they wanted to liquidate some of their assets and buy that. So that's been another part of it. Some people seeing amazing other investment opportunities in different markets. So I think one of our lenders has withdrawn money to buy some kind of delinquent housing assets. And another reason that has been given is a lot of our lenders, particularly our bigger lenders, have quite big buy-to-let property portfolios, and they're having to prop those up on the lending side. They want to get more money into those portfolios so that their interest rate can come down a bit. So a lot of different reasons. I don't think we've seen any significant lenders pull money out because performance has been bad. I mean, just to give you some stats on that, because it's something that we like to tell people. Lenders where you've lent more than 50 loans. So a typical loan is about £400 or £500. 98% of our lenders are in profit if they've lent on more than 50 loans. That falls quite dramatically. So if you've lent less than 10 loans, then it's 71% are in profit. Okay, so obviously diversification is really important to our lender base, and the bigger lenders, I think, are all very happy with the returns they're getting. Some of the smaller lenders, I guess, if they're in the 29% that haven't made a profit, they might not continue to invest for that reason, that they haven't seen a profit on their relatively small portfolio because they haven't had the diversification. And that's kind of a limitation of our product, right? I think probably one of the things that you asked me last year is how much does it take to invest in the money platform? And our smallest loan size is £250. So to do 50 loans, you need to deposit, I don't know, what's 50 times 250? I think that's 12,500. So that's kind of the kind of deposit size that you need to get like really adequately diversified. I mean, obviously these loans are turning over every 3 months, right? So you can get diversification just by keeping your money in there and keeping lending. But it's really good to just give the listeners on this program just a flavor of the returns. They are, if you're investing a small amount, this probably isn't the platform for you because you won't get the diversification. If you are able to do 50 plus loans, 98% of our lenders are in profit, and so that's something that's worth considering in your lending.
Yeah, just wanted to ask you, since we're kind of talking about percentages and what investors can return. Somebody in the chat had asked, and I'm not sure where Dave is getting this number from, but he said, Dave Dawson, the forecast returns for this year are quite low, 6.3 to 7.2%. Does this include tax at 20%? But you had mentioned a very different amount. So
yeah, sure.
Where is the discrepancy?
Yeah, so if you, on our website, there's a page called the outcome statement, and it's got a bunch of different numbers, one of which is the 15.4% forecast return, which I mentioned, and it also shows last year it's 26.0% against a forecast of 13.4. Now, where Dave is coming from is he's looking at what we call the net return, which is after tax, after an uninvested weighting, and obviously the gross return, that the 15.4% is obviously after our fees and after losses and all that kind of stuff. But we then have another number where we like to show it after tax and after possibly cash drag. And the reason we like to show that is because most of our lenders have to pay tax. We assume they pay 40% tax. Most of our lenders will have some cash drag during their year. And so we like to show like what could a realistic rate of return look like for a typical lender. A lot of platforms don't do that, by the way, which I think is a little bit disingenuous, because they might see a return of 13% and actually they get 8% at the end of the year once they've paid their tax. So we assume a 40% tax rate. We assume that you have 25 to 35% cash drag. And when you add those two bits together, that takes you down from 15.4% forecast for the coming year to 6.3, between 6.3 and 7.2%, with that cash drag being 25 to 35%. So that's how we go from the higher number to the smaller number. Part of the reason for doing that is to give an accurate expectation to lenders of what their returns will be, and to remind the ones based in the UK that this is taxable income. And part of it was also, frankly, that when we launched our outcome statement, the returns were incredibly high. In 2020 to 2021, it was 59.4%, and we wanted just to make lenders very aware that there's a chunky tax bill to pay on that if you're based in the UK and if you're liable for tax. Now 2020 to 2021, you can see that on our outcome statement. We've got some explanations of why that was so high. It was COVID. So typically our customers, they might take a loan, a short-term loan to buy a new boiler or something like that. And during COVID, there were all these intermittent lockdowns. So they would then get locked down and then they'd find it very easy to repay. So our default rate went through the floor. We're no longer obviously in COVID, so we're not expecting that to continue.
Okay. Just tell me quickly, what is the current size of the loan book that you're holding right now?
Sure. So we don't really think in terms of the current size of the loan book, because the loans turn over so quickly, because they're 1 to 3 month long loans. So we're doing about 1.2 million a month. I think when we added up all of the balances, so that includes some like repayment plans, so some delinquent loans that we haven't defaulted, it was around the £4 million mark. I'm not quite sure what it was, because we tend to think in terms of the monthly volumes. So £4 million, obviously that sounds really, really low, and it is really low. I think it's worth just remembering that our loans are turning over very, very quickly. So if you compare us to some of the other kind of peer-to-peer consumer credit platforms, there aren't that many of them these days, but they might be lending a few £100,000 a month, but their loan book will be much bigger than ours, because their loans might be 5 years long. So part of the reason to move to this 12-month product is to build up the size of our loan book, which we think will be helpful.
And George, how has the loan book performed in 2023? Obviously, consumer loans, bit of a different animal to say something like property-backed lending. You are basically, if I'm guessing, personal guarantees type. No real security, right? Other than you're looking at credit scores, trying to figure out, probably similar to credit card lending. You just, are these people going to pay back? Do they have personal guarantees? So how have the loans performed in 2023 as far as the defaults go?
So so far so good. We look in our business year so it starts on the 1st of February and it runs through to the 31st of January. So we're coming to the end of it. We forecast 15.4% return. We very much expect and hope to hit that at this point. So far so good. I mean, what we have seen is probably more customers with mortgages applying, which tend to be slightly better credit risk of type of customer, and that's probably because interest rates have gone up. So people covering short-term kind of shortfalls with their mortgages possibly there. But yeah, so far so good. I mean, as we've grown, things have become less volatile. So things have become more steady, and it's more predictable how things are going, and that's continued to be the case. We haven't seen much of an impact from the cost of living crisis. So yeah, I mean, so far so good. I'm lending, and I'm still lending. So and we've got lots of people involved as board members or as investors, equity investors, lending on our platform, and we're all very excited about not just what the rest of the year brings, but also what 2024 brings. I think we've got more tools at our disposal, easier to predict credit risk than we've ever had it before, and yeah, all is good.
So the big question: how do you collect money from people that don't want to pay?
Yeah, it's tricky. It's really tricky in our space because we don't have, these loans aren't secured. There's no property-backed elements. Although I would just say, as someone who's lent across a number of different platforms, I do speak to some lenders who say, "Oh, well, your platform's obviously more risky because it's not asset-backed." And there's obviously some truth to that, but it does slightly depend on what the valuation of the asset is and what the security of the asset is. Blah 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 blah. So just to raise that. But yeah, we don't have any recourse to take assets. So what do? We have kind of an internal collection strategy which we're constantly tweaking. And we try very hard to set up an affordable repayment plan. I would say not just most, probably almost every single person we lend to wants to repay. It's simply a case of can they repay? And so we try extremely hard to make sure that everyone is given the opportunity to pay what they can pay, and we work with them to make sure that happens, and we can point them in the direction of organizations that can help them on that front. So we're hooked up with a few of those different organizations. If we do find people who don't want to pay, and we would move those loans to default, then that obviously goes on the customer's credit rating. We report to TransUnion and Equifax, so two of the credit bureaus, and that will, it does cause problems for customers. So we do see them coming back and making up payments once that goes on their credit file. So actually, we have defaults repaying all the time. We've had some defaulted loans from 2017 repaying this year. So there's lots of collections quite late on in the cycle, particularly I think with our customers, where generally the intent is there, it's just sometimes the means isn't. Mm-hmm. And actually, Lawrence, one of the big things that we're doing is building a kind of financial education, financial learning platform, because we've noticed that a lot of our customers just don't have basic financial skills and knowledge. And so we think we can help them by training them up, but also help ourselves and help our lenders by providing our borrower customers with the tools they need to manage their money better. And if they can manage their money better, then our lenders benefit, and ultimately the borrowers benefit as well, because they don't get into expensive lines of credit. They don't need to stack up loans, and they can clear off their credit and become debt-free long term. So that's something that we've just started a process of building out those tools, and hopefully over the course of the next 12 months, maybe in 12 months' time, I'll rejoin you, and hopefully we'll have some really cool, exciting tools to demonstrate at that point. But that's something that I think will make a big difference to a lot of our customers. Mm-hmm. So yeah.
You should just tell them to subscribe to the Financial Thing channel, and then they can become really educated about financial education. Or I was thinking the other thing you could do is just get one of our viewers to go around and knock on their door and say, "Hey, mate, you're gonna pay? I got money in one of your loans." But
we've had a few people want to do that actually, which well, we can't. Yeah, we're not.
Might be a conflict of interest.
That's not something we're doing.
You don't want your mate Dave knocking on the door saying, "Hey, come on, you better pay up, or there's going to be trouble." I know I had a question for you, but you already answered it. Was what was the minimum lending amount? So obviously that's £250. Let's talk a little bit about the peer-to-peer lending sector in general. I I feel, some ways we have this contraction, which is not necessarily a bad thing, because if the industry has a bunch of bad players in the market, then contracting out those people is a good thing, and that needs to happen for this sector to grow. What's your personal feelings about the peer-to-peer lending sector as a whole now? Do you think it's going to continue to consolidate, or do you see growth in the sector?
I'm always really I'm quite optimistic by nature, but so I think we've been through the washing machine, as it were, and everyone has come out better for it. I know a lot of people involved in the P2P market would not agree with that statement, but P2P platforms are more secure places than they've ever been. They're a better experience for lenders, and probably a better experience for borrowers as well, actually, than they've ever been. And that comes down to a couple of different things. So firstly, the FCA has forced upon all P2P platforms this wind down plan. So you won't get a situation where a platform just shuts down without anyone collecting the loans. We've got a wind down plan, which should mean that every single loan is thoroughly collected on in the event that the money platform can't continue as a business. That said, we're a profitable business, so hopefully that won't be the case for us. But if that was to happen, then we've got a thorough wind down plan, which has been looked at and approved by the FCA. All the platforms have had to make their lenders way more aware of the risks, and I think that means that we've got experienced, more astute lender base than we've probably had in the past across the whole P2P universe. So I think that's a good thing. And I think as part of a whole bunch of regulations that have come in over the last few years, all P2P platforms have basically been forced to become much more resilient businesses, and they're forced to think about their risks in much more detail. And I think that probably means that you won't see as many corporate failures as we've seen. I mean, I've lent on a couple of P2P platforms that have gone bust, and it's a terrible experience as a lender. You don't know what's going on. You don't have anyone chasing up the loans. Some of them are secured loans, and there's no money coming back, which is kind of a weird experience to be in. So I think we're in a much better position. I think rates have probably peaked now, and I think they're probably going to come down, possibly quicker than everyone thinks. I don't know. So I like to think that from this kind of low point, possibly a low point for many P2P platforms, and certainly for the industry, I think P2P can make a bit of a revival from here, and it will be that the stronger platforms have lived on, and I guess I'm becoming quite kind of Darwinian about it, but I think we'll see things improve from here. I think I probably said the same last year, so you've got to take everything I say with a bit of a pinch of salt. But I think things will improve from here, and I think certainly interest rates have probably. I think there'll probably be consensus now that they've peaked. That wasn't the case last year, and that's been a massive headwind for P2P platforms over the last 12 months. So yeah, I'm optimistic.
Okay.
Yeah.
That's good. Well, we'll check back in a year and see if the predictions have been true. I have my own theories about interest rates. I personally think that we are in a new norm of interest rates now because of the inflation problem, and that maybe the Bank of England and the US Fed is going to have a bit of a problem when they reduce the rates and watch inflation start to spike again and end up having to increase them. So we'll watch this space, though. We'll see what happens.
Possible. I mean, the other thing I would say, on possibly a more pessimistic note for like P2P aficionados and P2P geeks like myself, I think when platforms, we haven't done this yet, and but I suppose it might come at some point where we've got a small loan book, as I said. When platforms hit a certain point, it seems to be the case that they then go and get a lot of institutional money, and the P2P element gets pushed to the wayside. And often they try and run the two alongside each other, but then the P2P lending bit becomes a bit of a regulatory headache and a bit expensive to run, and you've got lenders asking questions and stuff. And I think it's a bit of a shame that you've seen people like Assets Capital shut their lending business, P2P lending business over the last 12 months. But I can kind of see that from their point of view, they've obviously got great lines of credit coming in, and it's more expensive running a P2P lending business. So I think there's got to be a balance, and maybe at some point the FCA will see the value of peer-to-peer lending, and realize that it's in its new form. I think it's a really great part of an investment portfolio. You would be foolish, I think, to invest all of your assets in peer-to-peer lending, but equally having a slice of your assets in P2P lending, it seems like a good diversification.
Mm-hmm. And for everybody out there watching, please just give George a thumbs up if you can for taking time out of his evening to come here and chat about peer-to-peer. So hit that thumbs up and subscribe to the Financial Thing channel if you haven't. George, you perfectly segued into my next question, which is genius, about institutional money coming into peer-to-peer. We've seen some peer-to-peer companies turning their backs onto the retail investors. You mentioned one of them who generally, and I think I could speak freely, opinion-based, of course. So we're not the happiest campers in the world when it comes to Assets Capital for lack of communication, really letting us know what's going on. And it's unfortunate that they treat the retail investors like that, the ones that build up the companies and then just turn their back on us and say, we don't need you anymore. And by the way, we don't know when we're going to repay you. But anyway, what is your stance on institutional money for the money platform? Will you continue to support retail investing, or do you plan on looking at the institutional route because it is easier, regulatory, and maybe cheaper?
So I mean, we're really keen to. I'm really keen to continue doing peer-to-peer lending into perpetuity. I think it's the backbone of our business. It's why our business started, and it's what's made us successful. I think, just speaking frankly from our point of view, we have a slightly unusual product in terms of the short-term loan product, and it's quite hard to see institutional money working that easily with that, because there's such a high turnover, and trying to understand the products, and it is a bit of an unusual product. But I think there's probably a bit of room for both at some point. I don't think we're quite there yet, but I'm sure at some point that for institutional money to come in. I'm not sure. I think you would be very careful who you get into bed with, as with life. You never quite know. I think we've got P2P lenders who have been with us for 7 years. I think institutional money can be very flighty, and you've seen that with some platforms that have gone down the institutional route and then find themselves find the funding lines withdrawn, and find that the interest rates suddenly become very expensive if they don't hit certain covenants. So I think we're really keen to keep our P2P lending platform open to everyone, not just sophisticated, not just high net worth, but also retail. We've got a great sweep of different lenders from different backgrounds, and we're really keen for that to continue, hopefully forever, if we're able to, and if the FCA continues to allow P2P lending to occur, which I've got every reason to believe that they will. So yeah, very keen to continue P2P lending.
Speaking of the FCA, them grouping peer-to-peer lending in with cryptocurrency, it seems like at the moment they are intent to do that. They've had restrictions on how you can advertise now as a platform trying to reach new investors and new lenders. Have those restrictions affected the money platform in any way, or is it something you never really were using to begin with?
So we never have really done much like lender marketing. I think some other platforms, you've seen their advertisements on the tube, and you've seen them on the side of buses and all that kind of stuff. We've never done any of that, and but yeah, I mean, it's certainly changing. It's changed the narrative, and I think it's changed who you can reach and how easily you can reach them and what you've got to say when you reach them. So one of the things that I think was very frustrating for a lot of P2P platforms was this phrase: if you invest, you can lose all your money, something like that. But I mean, that is a statement of the bleeding obvious with any investment decision. But it seems strange that we, like peer-to-peer lending and crypto, are put together, because most lending opportunities are much lower risk than many equity investment opportunities. I don't want to generalize, and I don't want to give any risk advice, because I'm not regulated to do that. But that is it's clearly the case that a fixed income opportunity is generally speaking less risk than the average equity investment, and yet equity investments seem to come under a much lower level of scrutiny. I can open a trading account on Free Trade or Hargreaves Lansdown in a couple of minutes and bet my life savings on some small listed cannabis producer. To set up a P2P lending account will take me at least 24 hours, because there's a 24-hour cool-off period, and I'll have to go through a whole exam just to open the account. So yeah, I think there's definitely a bit of inequality there. I attended some of the industry roundtables with the FCA, and a lot of these different points were raised. Probably better than I can say them, but it is what it is. For the money platform, most of our lenders have come through word of mouth. Most of them are sophisticated P2P experts. Many of them are shareholders in our company, and so it's not been a big problem, to be honest. And I think in a way, and I don't want to be overly positive, but in a way it does mean that all of the lenders who do come through our door do actually know thoroughly what they're signing up for, and are probably quite pleasantly surprised when they see that they don't lose all their money, and that that they do actually make money. Well, at least 98% of them, if they've done more than 50 loans, make money. So I think they're probably pleasantly surprised by that. So yeah, I think pros and cons of some of these regulations.
I've been I get pleasantly surprised when I don't lose all of my money now in peer-to-peer, because I've been in so many of the ones where I have lost all of my money. So oh my God, I didn't lose all my money.
Have you lost? You haven't lost all your money, surely.
I mean, I'll give you an example. Collateral was one that is closed, and we haven't seen a penny back, and that was years ago. So I pretty much consider it all gone at this point, but who knows? Maybe some will come back in the future.
Yeah, I mean, that's a good point. That is a good point. You can, but particularly before the days of the wind down plan, it probably was possible to lose all your money. But right now, I think, every platform has to review their wind down plan and has to have a plan, a funded plan with money in a segregated account for how they will wind down, do a solve and wind down of the company. So I think I see it. I think it's hard to see how you could lose all of your money in peer-to-peer lending today. But obviously, the FCA wants platforms to say that, and of course, there is a risk. As I say, it's obvious that any investment could go wrong, and that you could lose all your money. But I just don't see why the peer-to-peer lending and crypto need to be lumped together with that. But for the money platform, we kind of like to see ourselves as equity market type kind of level of returns, but with lower volatility. And I think that's probably often the case for peer-to-peer lenders. You're trying to target equity market types of returns, but with lower volatility. And so just to come back to it, I do think it's a great part of any investment portfolio. It shouldn't be your whole portfolio. I think the FCA would very much agree with that, but it could be a part of it.
Here's a funny thing, George. I have never lost all of my money in crypto, but I've lost all of it in peer-to-peer lending, which I'm a big fan of peer-to-peer lending. I still think is a great business, and this is obviously from older companies that were Collateral, for example, operating under the premise that they were regulated when in fact they weren't. So that's really a fraud case. But I always, when I look back and go, I've never actually lost all of my money in crypto, because even if I buy something that loses value, I still own that, that percentage of a Bitcoin. And the only time I lose money is if I sell the actual, or even a stock or a share. So I think that's kind of ironic that the two are grouped in together, when some could argue that maybe Bitcoin isn't super risky, like people say, you're going to lose all your money. I'm like, I don't know about that. It's never happened to me, but it could.
Have any of the platforms that you've lost all of your money, presumably none of them are still going right now?
No. Well,
yeah.
I mean, no. And you can't even say that you've lost all of your money, because even in the ones that were operating for even a year or 2 years still paid you interest back. It's the question of whether you actually took your interest out and put it back in your bank, or if you just kept compounding it inside the platform. So then, yes, I think there's been a couple, but none of them are still operating. No, and I can't foresee any of the ones operating right now as being likely that you would lose all of your money because of the regulation. But yeah, of course it can always happen. I think it has to.
Yeah, I mean, investments. You've got to. It's not putting money in the bank. It's not FSCS protected.
Mm-hmm.
You've got to be prepared to lose your money, and I guess you have to be prepared to lose all your money. But we try and, as I say, I don't want to. I'm very verbose, so you've got to stop me. But we try and think of ourselves as kind of equity market style returns, as I was saying, but with lower volatility. So
yeah,
I think that's where most P2P platforms would view themselves today.
Again, if you have any questions, just put them in the chat. We'll run through them quickly at the end. We've been going for close to an hour, so I'm not going to take up too much of George's time, but put them in the chat. We've got a few questions that we'll fire off at the end for George. I have a couple of other questions. So as far as your operations within the business itself, is the money platform seen a profitable 2023? How are things on the business side?
Yeah, so the business I think has been profitable since January 2022, so almost 2 years now. We report, like we create monthly accounts, and we, some months are profitable, some months aren't, but generally speaking, we're profitable. We're certainly expecting to be profitable over the course of this year. And yeah, continuing to make profits. We've reached a certain scale where that's becoming like relatively straightforward. I think for us, it gives us huge ability to now reinvest that money in the business. One of the things we've done since I last spoke to you, Lawrence, was we've hired a bunch more developers, and that's giving us the ability to build some of these tools that I've been talking about, and do some of the cool new things that we've done over the last 12 months. So we've now got, I think, seven developers working for us, building new features on our website. And so all of the listeners to this who are lenders should hopefully, there's been a few kind of little bits of progress over the last 12 months, but there should be a lot more coming. Our website, for example, is pretty out of date. We haven't really updated the front page for a long time. So we're hoping that a new website's gonna go live in the next month or two. So yeah, a lot of changes going through, and all of that being reinvested, all of our profits.
Okay. Okay, so talking about platform failures, it's the number one question I get asked from especially new lenders coming who are interested in lending to different platforms. I asked you the same question a year ago, but I always like to ask it to see if you have any other thoughts or whether your thoughts are the same. But what advice do you have for new investors coming in and looking for safe places, reputable peer-to-peer platforms to hand over their hard-earned money to try to get some kind of a decent interest return?
It's quite hard now to find good opportunities. I suppose what the difference between this time and this time last year was that the Bank of England base rate's gone through the roof. So I think that when I think of other P2P platforms in the space, particularly ones that I've got some of my own money in, I'm not sure all of them stack up very well against a 1 year account with a high street bank, to be honest. But I don't. I mean, there probably are ones. I do think the money platform is different because the returns are just significantly higher, and so that's why I lend with the money platform. I don't want to advertise any other platforms, and I don't want to discredit any other platforms. So I might pass on that one. Right. But tell me, are there any others that you would particularly rate?
Are there any that I particularly rate? Yeah, there's a few that I think are operating in this space well. Again, not financial advice, but everybody knows I talk about these platforms all the time. I think LoanPad is doing a really great job. I've been lucky enough to go visit some of these platforms, on some of them multiple times. And I'm kind of a gut feeling guy too when I meet people. I don't know what it is, because I think if somebody shows you things within their company, only they know whether what they're showing you is actually the real truth. So sometimes you can only go off what you also learn about the individuals running the companies, what their backgrounds are. So I think, from that perspective, I've been to LoanPad. I think they're doing a good job. Cufflink has always been very good as far as me being transparent to me personally about what's going on over there. Propland, I think, are doing good in the commercial space of peer-to-peer lending. The Blend Network, I think, is doing a good job. So there's a handful, and there are others. I mean, the problem is, as a lender, you only have so much capital to deploy. And I think if I was a rich man, there'd be several companies that I would probably allocate money to, probably 10, that I think are operating in this space well.
Yep.
But I was wrong.
What do you think constitutes like a good rate of return right now in today's interest rate?
I think it obviously you'd like to be 2 points above, I think, what an FSCS protected savings account could get you, maybe 1.5 to 2 points. There's also a bit of a morality.
I'm surprised you'd say that low, to be honest.
Yeah.
Particularly for the ease of that, like, I don't know. I think frankly, for too long, P2P platforms have kind of taken their lenders for granted, and have not delivered particularly good returns. As a lender, I think, that's not very good, and I think there's quite a lot of competition. A lot of platforms have had to up their rates. So, I mean, I don't want to. Yeah, I don't. It's interesting for you to say those names.
Well, I have to also say that on a personal level, I don't particularly like high street banks because they have treated small businesses really foully. As far as most small businesses can't go to a high street bank to get a loan. So there is kind of a bit of a moral standing on my part that I don't want a bank who I know can take most, I think 100% of everything you deposit and lend it out without having to keep anything. And if there's a run on the bank, as we saw happen in 2008, there's that sort of negative side. And so I just really don't like big these huge big banks anyway. So if I could get a couple of points higher and know that I'm in relatively good hands, that risk for me is worth it, for me not also having to support those high street banks that have treated, I think, consumers, pretty poorly, and also small businesses very poorly with giving them access to lending. So there's that side of it too. But that's all personal opinion. If I didn't care about the morality side of high street banks and what they stood for, I'd probably say, maybe you need to get more than a couple of points. But for me personally, a couple of points, I'm okay with that. I really am.
I guess every pound invested in a P2P platform or an alternative lender is it's a pound of additional competition to the banks.
Mm-hmm.
I think a lot of the challenger banks as well it has led to a lot more competition. We've got a couple of bank accounts just as a company, and one of them is with Revolut. One of them is, in fact, we've got two with Aldermore, and those are banks that didn't exist 20 years ago. So it's cool to see that competition coming to the space.
Yeah, there isn't, and I've also seen some of these companies start from zero, some of the peer-to-peer lenders, and I personally choose, even though there is more risk, I like to support that growth of the business in the sector, because what they do is very hard and very difficult. It's not an easy business to go out and find the loans and then to balance how much money you're getting from retail in order to fund that lending. So there's a bit of that going on my end, but I wouldn't also be upset if people looked at it and goes, well, I'm not really getting enough money the risk reward isn't there. If I'm only getting 7% when I can get 5 in a bank, it's probably not worth the risk. But there's also peer-to-peer lenders that are offering 10, you can get about 10%, 9, 10, 11% yourself. Also, your company is offering that higher return possibly with the risk. So.
Yeah, we're not offering a fixed rate of return.
No,
so some of the other platforms, actually that is a key difference, which I should just mention, compared to a lot of platforms where you get a fixed coupon. When I say that we're expecting a 15.4% or whatever, 15.4% for the current business year, that is not fixed. The fixed rate is significantly higher than that, but we get a bunch of defaults and we don't have a provision fund or anything like that. So, the defaults are paid for by the lenders essentially, and that's what brings down the return from what would be a very, very high fixed rate to the 15.4%.
Mm-hmm. Yeah, they're always estimated too. Whenever we talk about these rates in peer-to-peer, they're never just one flat amount.
Of course,
so.
Yeah.
But yeah, I do.
Even with those fixed rate returns, if it's a bridging P2P platform, for example, sometimes you get customers who are late on paying, and so you don't get when you do like an IRR of the return you've got, it doesn't match the fixed rate that you're supposed to get. So
yeah, absolutely. There's a couple of questions in the chat. I'll just kind of fire on because I know we've been going for about an hour, so won't keep you too much longer. But let me just fire these off to you. Some of them are going to be quick. Are you going to offer a alternative ISA?
Not anytime soon. There is potential for it, but most of our lenders already fill up their ISA by the time they're filling it up with stocks and shares. So we tend to be, most of our investors are probably investing more than the ISA limit every year, and we're the kind of we're one of many P2P platforms that they invest with, and so it's not something we get that much demand for, to be honest.
Mm-hmm.
We're not planning to offer one, and I am very interested to see what the Chancellor comes out with next week, because I think he is going to abolish the innovative finance ISA. You heard it here first, but I don't know that for sure. But I think that might be on the cards next week. So
I hope so. It's too complicated.
It is complicated. Yeah. It's a bit of a shame, though. I think like it is a good way into P2P lending, and it's.
Don't you think they'll offer a different way to do it, though, rather than just say abolishing and say, well, you can invest wherever you want as long as that alternative finance company offers an ISA? We are not going to have this separate ISA just for them.
Possibly. The narrative I have heard, which I think is a shame if it goes down this route, is that retail investors should not be. I mean, it's bizarre that this is even being talked about, because this is the FCA that should be making these decisions in consultation with businesses. The narrative I've heard is that retail investors shouldn't be investing in peer-to-peer lending, and if ISA shouldn't be available, there shouldn't be an ISA for. I mean, let's see what happens. That's just something that I read.
That's crazy.
I can't remember what it was. But it is crazy if that goes ahead, because you can't. I mean, it's just bizarre. Like that, you can lend as a retail investor. So why would the Treasury make up some different rule?
Because they're the government.
There's a lot of misinformation about P2P, right? There's a lot of people who don't understand it. It's a lot of people who don't understand the risks with it, and think that it's to be lumped in with crypto.
Let's see what happens next week. How quick does cash get lent out if you deposit? Do you have a lot of problems with cash drag, or does it tend to be pretty quickly lent?
Really depends on the volume that you're lending. Normally, so we say cash drag of 25 to 35%. That is not. It hasn't been as high as that in the last year. It's often very low, too low, in my opinion. So if you're lending 10 grand, it would get lent out in the next few days. If you're lending £200,000, it will take a bit of time, but it just depends on the amount.
Okay. And is there a queuing system, or is it the quickest finger to the keyboard?
It's a queuing system, so it's very easy for lenders. We try and make it easy for lenders, and hopefully it will get even easier. It's a queuing system, so you sign up, you deposit, you enable your offers, and the money just gets matched with borrowers coming in on a queue.
Easy.
Yeah.
Good. John Day says, George, can you profile your borrower mix for us?
Sure. Yeah, that's a really good question. So they're generally, I'm just going to give you the typical borrower, because that's the easiest. So they're generally young people in their 20s or maybe in their 30s who are thin file customers. What do I mean by thin file? The light's just gone off outside, but hopefully you can still see me. Mm-hmm. Thin file customers are customers that don't have a credit history or a thick credit file in the UK. So they don't have a mortgage, they don't have lots of credit cards or car debt or anything like that. So the banks look at them, prime lenders look at them and think, I don't know who this guy is. I don't know if he's repaid credit before, and I don't know what to do with him, so we'll just reject him or her. And we take a slightly different view, and we try and dig into who the person is behind that thin file, and try and find out if we can underwrite them. And we use a bunch of different tools to do that. But yeah, I mean, the short answer to John's question is that there's probably millions of people actually in the UK who can't access credit. And the reason they can't access credit is because you can get credit if you've had credit in the past. So you can get a mortgage if you've got a good credit score. The way you get a good credit score is by having a loan in the past. It's a kind of horrible cycle where if you're at a certain age, it's actually quite hard to break into the cycle. We've got a colleague who works at the Money Platform who's just moved over to the UK. And he is unable to get a rental contract, unable to get a credit card, unable to even open a bank account because he's only moved here in the last 2 months and he doesn't have bank statements and proofs of address and all of this kind of stuff. And he's slowly managing to get that stuff and to get on his financial feet. But people who come over here to this country, or people who are young, who don't have all of the documentation, find it really, really hard to access credit, and they're exactly the type of people who might need some credit. They might need a loan to pay their deposit for a rental contract, for example. They might need a loan to buy a bike so that they can do Deliveroo. They're exactly the type of person we're trying to help, and they're exactly the type of person who does often get exploited by loan sharks. So that's a big part of why we run the money platform, is to kind of add some much needed competition into that space.
Okay, let's see. One more for you. Alan Stratford has asked, are most of the defaults total losses, or do some of them get back some or most of the capital?
Very good question. So if Alan heads over to our website and clicks through to terms of service and then clicks on terms of service, there's a page called outcome statement, which is a very long, boring article, but it talks a bit about this. And we're, as I said earlier, we're trying to redo our whole website so that it's much clearer and much easier. It hasn't been updated the content's been updated, but the kind of visual hasn't been updated for some time. To answer Alan's question, there are two different, we split them into two groups. One is called defaults and one is called delinquencies. Defaults are where we expect zero back. Delinquencies are where we expect pretty much everything back, actually. So that's where a customer just hasn't paid on time. And I think actually with the new system of people choosing when they actually get paid and us matching the loan payment dates to those dates, the delinquencies will go down quite a bit, possibly. But we get a number of customers who, as I said earlier, go on to repayment plans, etc. And those go into the delinquency bucket. The default bucket are people that, for whatever reason, we're not able to recover money from. Maybe they don't want to pay us back. Maybe they can't pay us back and are nervous of saying to us that they don't want to pay us back. But often that number does grind down over time, but those are the ones that are most problematic for us. People who want to pay us back, that's great. Like, we can work with them and find something to suit their needs. But yeah, to answer Alan's question, yes, we expect to get about 6-7% of our loans default, and about 10% go delinquent, so repay over a longer period of time than originally planned.
Okay. So anything else you'd like to tell everybody out there watching in the future about the money platform? Where can they go to sign up? This is your minute.
Okay, my
say
minute.
Whatever you want.
I don't think I've got a huge amount to say. I mean, I think hopefully everyone listening to this is excited about P2P lending. So I would say stick with the program, keep a toe in the P2P industry over the coming years. Hopefully there'll be really exciting things to come. Sign up to the money platform if you'd like to, just to see what it's like. And read some of our material and see how we develop over the next year. We've got a few new products coming, particularly for those who are maybe less wanting to invest in that kind of short-term, more risky space. So one of them is a longer, larger loan product, which we're going to launch hopefully early next year. We've been testing it throughout the whole of this year. We've lent to about 250 customers in that space, and we've been learning a lot, and we're hoping to launch it to the whole of our lender base early next year. That's one thing to say. Another thing to say is that we're updating our payment system, and that should, for lenders that use us, you'll see some changes there, probably a different way of depositing on our platform. So that will come in at some point next year. We'll send some memos out around that. And I would just say to anyone thinking of lending, as we've already said, capital's at risk. But I would say just do look at our numbers on diversification. It makes a massive difference if you're diversified. We do occasionally get lenders who invest in one loan, and that you get a good feel for the platform by doing that. But it goes one of two ways. You're either delighted because the loan repays and you earn loads of interest, or you're very disappointed because the loan doesn't repay. So just bear that in mind. 98% of our lenders over the last 5 years who have invested in more than 50 loans are in profit, and that number goes up and up and up as you do more loans. Whereas that's only 71% if you're investing in less than 10 loans. So it is diversification in our business is vital. We don't slice up our loans. You will lend as a lender to one person, and you are totally reliant on that one person repaying. I think it's great. I think it's kind of back to basics P2P lending. I really like it, but I know for some people that makes the platform a difficult investment opportunity if you're not able to allocate enough money to it. But yeah, let's see. And also the other thing to say is I love getting feedback. I love speaking to lenders. We often send around an email to lenders where you can book time in my diary to have a chat. Sadly, no one seems to ever do that. I think I've had about 2 or 3 lenders do that in the last few months. So please do that, and I can tell you more about the platform and more about how your portfolio is doing.
Mm-hmm. I think that's a great idea. If you are interested, just how can people reach you, George?
Good question. They can reach me on my. They can reach me on if they just hit the contact us page on the on our website and say that they want to speak to me, then they will come through to me. If they're already a lender, then they will get an email. Generally, we send a monthly email to our lenders, so there'll be some contact details on there. Okay. I don't have Twitter, so you can't contact me on Twitter. And I don't have, I've got LinkedIn. You can contact me on LinkedIn. George Huntley, the money platform on LinkedIn. So yeah, perfect. Always happy to be contacted. So that's how you contacted me, Lawrence. So
I did. That's good. See, I'm out there diligently working hard for the people out there trying to get information. But yeah, thank you again for taking the time to come and teach us all about what you do from the inside. That's really good. Hopefully we'll see you back here in another year, and we'll get a new update with hopefully a lot of growth and good results for the low defaults, hopefully, and lots of interest. Yeah. So very much appreciate it. And
cool. Okay. Well, yeah. Thank you very much, Lawrence. Thanks to everyone who's listened, and yeah, hopefully see you again in another year, if not sooner.
All right. Thank you, George.
Bye.
Take care. Okay. Bye-bye. So there you have it. George from the Money Platform. Hope you enjoyed it. I think it's an interesting, yes, obviously higher risk because you're dealing with people, consumer credit, no security behind it, but maybe the risk is there for the reward amount. But yeah, check them out. See what you think. And I'll be back next Thursday for another episode of the Financial Thing YouTube live stream. Thanks to everybody for joining. Don't forget, if you want to become a Patreon member, click on the link below. Appreciate your support as always. And back on the 30th, we'll be here, of course, back with Cufflink again, CEO Narinder. We're going to talk everything Cufflink on November 30th. So come join. And other than that, I will see you next Thursday. Have a great weekend, everybody. Take care of yourselves. Bye-bye.